Business retirement plans are basically a trade. You give employees a benefit, and the business gets a deduction. If the plan is set up and operated correctly, contributions and plan earnings generally grow tax-deferred until distribution. On the EA exam, they'll test two things over and over: what type of plan it is, and where the deduction shows up for owners versus employee contributions. Zoom out to the three big buckets you need to recognize: SEP plans, simple plans, and qualified plans. SEP and simple are designed to be easier for small employers. Qualified plans are the heavier duty category, like 401k plans and traditional pension-style defined benefit plans. Exam tip: if you see 401k or defined benefit, your brain should immediately label it qualified plan. Now, the deduction location. This is a classic EA exam trap. If you're a sole proprietor or partner contributing for yourself, that's generally an adjustment to income on Schedule 1 of Form 1040, and you need self-employment income to support it. But contributions the business makes for employees are a business deduction, and that employee-side deduction can exist even if the business has a net operating loss. Also separate who pays from who benefits. Employer contributions made on behalf of employees are deductible to the business and generally not currently taxable to the employee. Employee contributions, like salary deferrals in certain plans, are often excluded from current income and taxed later at distribution. The big picture is simple. Money goes in pre-tax, grows tax-deferred, and gets taxed when it comes out. Finally, don't ignore the real-world trade-off: administration cost. Qualified plans, especially pension-style plans, can be expensive to run, sometimes thousands per year for administration, accounting, and insurance. SEP and simple plans are usually cheaper and simpler. On the exam, if they hint high admin burden or complex compliance, that points you toward qualified plans, not a basic IRA-based arrangement. What is the latest date that a business can establish a simple IRA for its employees? The options include dates like September 15th, October 1st, December 31st, and April 15th. Remember, this is about when the plan must be established for the year, not when a contribution is deposited. Think about it. The answer is October 1st. A simple IRA generally has to be established by October 1st for the calendar year. December 31st is tempting because it feels like an end-of-year deadline, but that's not the rule for establishing a simple plan. Watch for the common exception. A new business starting after October 1st can set it up as soon as administratively feasible. Summit Climate Solutions Incorporated has 110 employees, and all of them earned more than $5,000 last year. The company wants to establish a retirement plan. Which plan type is not allowed? A 401k, a defined benefit plan, a SEP IRA, or a simple IRA. This is really testing eligibility rules. Think about it. The plan that's not allowed is the simple IRA. A simple IRA generally requires the employer to have 100 or fewer employees who received at least $5,000 of compensation in the preceding year. With 110 employees over that threshold, they're out. A 401k, a defined benefit plan, and a SEP IRA can still be options, even if they're more complex.